Hi, I'm Brittany. Today we'll cover FHA Streamline basics, when to use non-credit versus credit qualifying, key requirements, the net tangible benefit, and most importantly, how to calculate the max loan amount. Also, what do we do with that MIP refund credit? Rate and term FHA refinances are just your regular old refinances that you're used to. This is used when refinancing out of bridge loans, conventional, or even VA loans. Simple refinances are for folks refinancing from FHA to FHA and rolling in their closing costs. Rather than the loan amount being based on the appraised value like a rate and term, the loan amount is instead based on the payoff plus costs. But we're only going to talk about Streamlines for the time being. Streamlines are for current FHA borrowers. They're fast, simple, and there's no appraisal. 'Tis the season. Let's get retrained. There are a handful of changes to be aware of. FHA Streamline refinances are basically your shortcut button. Why do we use it? The purpose is simple. Drop that interest rate without burying yourself in paperwork. No appraisal, no income verification, which means no digging for W-2s. But there are a few rules of the road. You've got to already have an FHA loan. You've got to be current on your mortgage. No more than one 30-day late in the last 6 to 12 months, and none inside the most recent 6 months. And the biggie, you have to show a significant enough rate drop. No benefit, no streamline. So who's this perfect for? Homeowners already rocking an FHA loan who just want a smooth, fast refi to a lower rate without all the usual hoops. Think of it as the express checkout lane just for FHA borrowers. Here's the breezy option. Non-credit qualifying. No tax returns, no pay stubs, no DTI math. Hallelujah. Just keep the same borrowers, unless someone's gone due to divorce or passing. In the case of divorce, the decree must have awarded our borrower the house, and our borrower must be able to evidence they've made the last 6 payments. And we just peek at mortgage history. Remember, one 30-day late max between months 6 through 12, and boom, no appraisal, no fuss, like skipping the line at Disney. All right, y'all, here's when we actually have to go credit qualifying. This doesn't have anything to do with rolling in costs or increasing the payment. It is only required if we're removing someone from the note and the situation doesn't qualify for the divorce or death exemption. Like, the original's borrowers were not married and one wants off the note. Or, the original borrowers were married, but the new borrower cannot show they have made 6 payments on their own. Can't skip the credit checks there. So, what does credit qualifying actually mean? We're pulling full credit. We're checking income. We're verifying assets. We're making sure the borrower can still carry the payment. But here's the good news. We still don't need a new appraisal. So yes, it's more work than the breezy non-credit version, but it's still lighter than a full-blown refinance. Bottom line, we only go credit qualifying when we have to. Otherwise, we stay in the easy lane. Couple more tidbits. If funds to close are less than 1 mortgage payment, don't even worry about sourcing it. I love that one. No max LTV. Freedom. But we do need a net tangible benefit. So, a lower rate, lower payment, or product upgrade. 6 payments, 6 full months since the first payment due date, and 210 days seasoning required since last close date. Non-negotiable. This is measured from previous note date to new case number assignment date. So what counts as a benefit? A couple of things. Lower monthly principal and interest. Always a win. A lower interest rate. Sometimes even a shorter loan term. Or switching from something riskier, like an ARM, into the safety of a fixed rate. Now, let's break it down by type. Number 1, fixed to fixed. Say you're going from 6.5% down to 5%. There's got to be at least a 0.5% rate drop for it to count. Number 2, ARM to fixed. Moving from an adjustable to a fixed? That's a benefit on its own. Doesn't matter if the rate only dips a tiny bit. FHA says stability is enough. Number 3, arm to arm. Okay, if you're gonna stay in the arm world, you need a big improvement, at least a 2% rate reduction. It can also be met by a 3 or more year reduction in the term, plus an interest rate that's the same or lower. Plus, the new payment doesn't exceed the previous payment by more than $50. That way the borrower is clearly in a better financial position. So in plain English, net tangible benefit means the refinance has to make the borrower's life noticeably better, cheaper payment, safer product, or both. No benefit, no streamline. Simple as that. Okay, math nerdy birds. Here's your turn. The base loan amount is based on the lesser of two things. 1, your unpaid balance plus little extras like interest and escrow, or 2, your original principal. Whichever is smaller wins. Think of it like splitting dessert. Somehow you always get the smaller slice. And, oh yeah, the MIP refund has to be deducted from both of these calculations. But no worries. I made a calculator for you. All you have to do is fill it out. Here's the calculator in action. Start with your payoff figures. Most payoffs come back right away. As soon as you've got the customer's mortgage statement, just call the customer service number and follow the prompts. In many cases, you'll get a verbal payoff on the spot. Next, factor in the MIP refund. This isn't pocket change. It can be several $1,000s and directly affects both the loan amount and cash to close. Do this work up front. The last thing you want is to tell a customer you estimated wrong and their cash to close jumped from $1,500 to $3,500. That's not the kind of experience a true mortgage advisor delivers. The setup department will provide us with the exact MIP refund when the FHA case number is ordered, but we can't order that until we have an application. So for estimate purposes, you'll follow this chart to drum up that figure. This refund gets applied as a credit toward the upfront MIP on the new loan, which helps lower the total loan amount. Now, as you can see from the table, the refund percentage starts at 100% if they refinance in the same month, and it gradually decreases each month after that. By the 36th month, or 3 years, the refund drops to 0. So for example, if someone refinances in month 6, they'd get about a 70% refund of their original MIP. But if they wait until month 24, that drops to just 28%. This is a great talking point when working with borrowers who are refinancing early. It can save them a decent amount on their new loan. Okay, but good news. I added this to the loan amount calculator for you. So again, it's just plug and play. You need the customer's mortgage statement, CD, and note. Create your checklist now. Driver's license, survey, mortgage statement, note, CD, and utility bill or pay stub, showing the subject address because FHA requires evidence of primary occupancy. You only need assets if the cash to close is more than the amount of the new monthly payment. That's pretty much it. If you need help, just holler.